We are heading to the closing bell, and to get us there, Jeff Klingelhofer from Thornburg Investment Management, the co-head of investments, along with Scott Wren, Wells Fargo Investment Institute Senior Global Equity Strategist. But right now, Jared Blickery's watching markets after Janet Yellen. Wasn't exactly yelling from the rooftops, but it was enough to make people upset.
That's right, Adam. And guess what? She's doing Fed Chair Powell's job. I'm getting everybody confused now. Nevertheless, the market did not like this one bit. Let's take a look at the Wi-Fi Interactive. We got some charts to show you. Here is the Nasdaq. Janet Yellen made those, Treasury Secretary Janet Yellen made those comments at about 11:10 a.m. and we went to session lows after that. We are off those lows, but in the bottom end of the range, probably going to close with the worst performance since about March. So keep in mind that we've been here before. We've had corrections this year in the Nasdaq before. They didn't necessarily seep over into the broader market, so all is not lost. But check this out. Apple down 3%. We got Alphabet, Facebook, and Microsoft, Tesla, all down more than 1%. And the chip stocks, we've been warning about this for a few days now. Some, what do we call it? Chinks in the armor. ASML is down 4%, NVIDIA down 3%, Applied Materials as well. When they started going down a few days ago, that was kind of a signal that the breadth in the market, at least in the Nasdaq, not the S&P 500, could be an issue. But we want to take a look at the sector action because it's a bifurcated market. The value and cyclical trades largely outperforming here. We got materials up 1%, financials, industrials, energy, healthcare, all in the green. And to the downside, we got those mega cap sectors, tech, discretionary, and communication services all down 1 to 2%, as you can see on your screen there. Something interesting, let's take a look at the bank stocks because these are flying high. JP Morgan up over 1%, Bank America up 1% as well. Heading into the closing bell here, not the best day in terms of price action, guys.
It certainly is not, but at least I guess we're closing off the lows of the day. Like Jared was just saying, we saw markets take a bit of a hit after comments from Secretary Janet Yellen saying that rates may need to be raised here in order to make sure that the economy doesn't overheat. Investors were clearly spooked by what they heard, and you can see the Nasdaq, although it was off over 2% for the majority of the afternoon, closing off just around 1.9%. S&P off just over 0.5%. The Dow, though, climbing into the close here, closing in positive territory, up just around 22 points, so not too far from the flat line. But taking a look at the Nasdaq, where it was the hardest hit of the major indexes today, big tech names like Jared was just going through, growth stocks leading today's declines. And taking a look at the sector action, you can see that reflected there. Technology, consumer discretionary, and communications leading the declines today. But let's bring in our guests. We have Jeff at Klingelhofer, and we also have Scott Wren here to break down today's action. Scott, let me start with you, just with the broader markets under pressure today, the Nasdaq closing off nearly 2%. What do you make of the market's reaction? Does it make sense, or is it a bit of an overreaction to what Janet Yellen said today?
Well, Sean, I think, it was an interest rate comment that really hurt the growth stocks, the big growth stocks. And I think we've in the last month or so, we've seen breadth narrow a little bit. In other words, the Russell 2000 has underperformed the OEX and the S&P 500. But for us, we want to lean. This is just a temporary setback here. And, the markets run so far, so fast that you're just not going to keep going up every day. So for us, we're looking for opportunities. We like the sectors that you mentioned that had outperformed today. So for us, pullbacks are opportunities. We'd like to see a little bit more of it. If we have some kind of an inflation scare, let's say we see some big numbers, that might offer an opportunity. But as far as we're concerned, these are just temporary setbacks, and we think the market is going to trade higher this year and higher next year as well.
Jeff, is that what we actually just saw? I mean, it looked as if people were buying into the close, the dip, at least with the Dow. Even the S&P was recovering off its lows. You don't want to be in bonds right now, so you really have no other choice but the markets. Are we going to see more of these dips and then people rushing in toward the end?
Well, I think we will. And the most interesting part to me today is on the back of a quote rates comment, treasuries were actually higher in price, lower in yield on the day. And that's rather interesting to see. I think what markets are doing is digesting, to Scott's earlier point, that the fact that we've run so far so quickly, we're so optimistic about the reopening, but the U.S. is so far ahead of the rest of the world. And yes, we'll face a reopening here, but we still have a long road to travel, which the Fed has been very vocal about talking about, and still a long way from normal. So I think it's just the market taking a step back, digesting that we've run too far too quickly, and pausing here for a brief moment.
So, Jeff, then given that, how are you positioned given the uncertainty, and then also, I guess, just what to expect here if you still think we are going to trend higher for the remainder of the year?
Yeah, well, the biggest thing is it depends on the solution you're trying to provide. So in the fixed income markets, I think you're better off playing defense here, right? Fixed income markets are generally supposed to be ballast for portfolios. So what we are telling clients at Thornburg is to play more defense within those portfolios. Within equities, there are still some sectors that we like, right? We've talked a lot about that value growth rotation. We still think that does have legs, but again, it's urging caution and taking a step back, perhaps taking some chips off the table, digesting incoming information. I think one of the biggest things we'll have to watch for as the summer unfolds is not so much U.S. economic activity, but global economic activity, right? The U.S. is one of the most open economies in the world, and largely, I think that we will face some setbacks in at least the extreme optimism that we have now.
Scott, you and I have talked about these kinds of things for years, and I think I'm about as milquetoast an investor as there is. Very basic. I think a lot of us try to keep it, as you said, keep it simple. Don't make this more difficult than it is. So as you look at what's happening in this market right now and we see the economy picking up, what should those of us described as milquetoast investors be looking at? I mean, retail's coming back, whether it's brick and mortar or online. There's plenty of places you can be putting your money.
Well, I tell you, Adam, it's blocking and tackling here. Is the vaccine situation going to get better? Yes, it is. Is the Federal Reserve going to continue to be easy? Yes, it is. Is there a lot of fiscal stimulus in the system? Yes. And, we certainly don't want to fight the Fed. We've all been around long enough that we don't want to try to do that. But you need to look ahead and say these lockdowns are coming to an end. There's a lot of pent up demand. The savings rate is very high. The unemployment rate's going to go down more. People are going to be spending money.